Welcome to the 7 and 7 podcast. I'm your host, Zack Ellison. This podcast is meant to bring the world's leading investors and their investment advice to a broader audience. Today, we're here with Brian Kasal, CEO and founder of FourStar Wealth, a leading wealth advisor based in Chicago. Brian, please introduce yourself and tell us a little bit about you.
Thanks, Zach. I'm glad to be here, and thanks for having me on your show. So I am the CEO and founder of a firm called FourStar Wealth Advisors in Chicago, and we founded FourStar in 2014. After my 30 years in the industry prior, with firms like Payne Weber, some of the old timers might remember that, Lehman Brothers, a firm in Chicago called William Blair, and then I did a stint at Morgan Stanley. So my objective in founding FourStar was part of the change in the industry where there's a shift onto the investment advisor world from the broker world. And so we're part of that whole trend. But we have advisors all over the country. So we're 35 advisors now in 13 states, and we're growing nicely, working with high net worth families all across the country and some overseas as well.
So Brian, you're one of the fastest growing wealth managers in the country, and I think part of that's because you're very innovative in how you think about investing. What are you working on right now?
Well, we're working on a couple things that I think are important. Right now, we have been doing an alternative investing, which is not stocks and bonds. It's private partnerships, whether it be real estate or business services, corporate debt, and various things where you can get a better return than the public markets. If the stock market is averaged a 10% return over time, and then the bond market's average maybe 3 or 4%, the alternative world in the proper allocation can earn 15% plus. So if you add alternatives to your portfolio, it really can be augmented and very positive. So we're creating an alternatives fund. One of the issues with alternatives is every time you invest in a private partnership, you have to do a lot of paperwork. And so a lot of people get sick of the paperwork. You also get a lot of tax forms, K-1s, and you have a 2-inch tax return. So by creating a feeder fund, people can invest into that fund and only get one K-1 and one document, but they have diversification within it. So we're trying to simplify, press the easy button on the alternative investing world. And that's something we're working on right now. And that's an important thing. That'll be offered as early as next week. So
wow, that's very exciting. That's very exciting. One of the themes I've been seeing a lot in the RIA segment is this move to try to get into alternatives because of the many benefits. But what I found is a lot of wealth advisors have been very slow to move, and they continue to really base their entire portfolio around the 60-40 allocation of stocks and bonds with little tweaks on the margin, but they've really missed out on a lot of the opportunities in private credit and real estate, private equity and venture capital over the last couple decades. What is it that led you to want to do this? Was it demand driven from your clients, or what did you kind of inspired you to build this out?
Well, I've done a lot of alternative investing, Zach, through my career, with my wife and I buying lots of different in the real estate markets and then different partnerships. And that's always been available to investors in some way. But now there's a lot more emphasis on alternatives. And, after a bad year like last year, the alternatives did very, very well. The bond market was the worst bond market in American history. Stock market, it was one of the worst, not the worst, but one of the worst as well. And so people are looking for other alternatives to get better return. So we have focused on that to the point that we're trying to make it simpler for investors to do that. Plus, there's a lot of qualifications that you have to be part of it. And there's some complexity that a lot of investors don't understand that well. So we're trying to make it simple. That's why we're doing it.
That makes sense. And you're definitely one of the leaders in the space. I think others are going to eventually follow, but it could be a while. So what's something that you're thinking about right now that you think is important that others might be missing?
Well, switching to the public markets, we're in a really rough time right now. Markets were higher at the beginning of the year. Now they're coming back to flat, and everyone's getting concerned. We're seeing a big banking crisis on right now. We've seen a couple of big banks go into receivership, and then the government took them over. So interest rates rising is causing problems for the banks. But I think anybody who's really watching long term always knew this might happen. So then the markets are reacting negatively to that. So what we're watching, Zach, now is the opportunity that this kind of environment creates, because every crisis leads to an opportunity. So we raise a lot of cash in bad markets, and we rotate out of the market partially or in some portfolios completely, and we're 3/4 of the way there already. So we're pretty defensive right now. So rather than looking at how bad it is, what we're looking at is saying, first of all, are we going to go to maximum cash? And when would we do that? And either way, whether we're bottoming now or we bottom later on, there will be great opportunities. And how are we going to take advantage of those? That's what we're focused on. We're not focused on the problem. We're focused on the opportunity, because it will be there, and it'll be real clear to people who are watching, but most people won't be, because they'll be in a panic about what just happened, and they'll forget what the opportunities are.
And the best opportunities happen because risks have just occurred. I always think it's ironic that people pull back and get very scared after the risks have already been realized. If you look back to 2010, coming out of the credit crisis, banks and many investors sat on the sidelines, and that was the best opportunity to get to the market. And I think we're going to see a similar opportunity coming up after this banking crisis. It'll get resolved one way or another, and ultimately that's when you want to be sitting on a lot of cash, like you said, so you can deploy it into the most opportunistic, interesting investments that others, will miss, because timing is so important. So I totally agree with you. Cash is king, and having dry powder when there's ample opportunities is ultimately going to lead to outperformance.
Zach, looking back to March of 2009, when the markets bottomed after the Great Recession, most people were in a panic right around then. The recession continued for 2 more quarters, but the markets tend to bottom before the recession is done, usually 6 to 12 months before the recession is done. So that was a great opportunity. Everyone knows that now. But during that time, most people were not focused on that at all. And I will make the argument again that just like then, when the markets finally bottom again, whether they've already bottomed in October or they bottom lower, most people will just be focused on how bad things are, and they're nervous, and they should be looking at the opportunity.
100%. I feel like people miss this all the time because of some psychological, heuristics or biases where they're just scared and they miss the opportunity. And that's why it's good to have a trusted advisor who can help you along, because sometimes you need somebody to rely on that's thinking objectively when you might not.
Exactly.
So with that, you've been in the market for almost 40 years now, which is incredible. And I wanted to ask you about some of your timeless investment principles. If you've got things you've learned over the years that kind of work for you and should work for everybody, I'd like to hear those.
So I would say investors should take risk when risk is being rewarded. So 85% of the time, the markets are usually moving up. They squiggle back and forth, but generally moving up. And about 15% of the time, the markets are either in correction or outright panic. So the most important time is that panic time. In the markets, when they're moving up, everybody makes money, everybody's happy, everyone, it's a wonderful environment. The most important thing is to have a plan when the markets are going down and try to minimize your loss. Because if you're down 10%, maybe you can recover and you can minimize your loss to that. You're down 20% the next couple of years, you can recover. But if you're down 30, Zach, 40, let's say 50%, if you're down 50%, you're going to have to double your money to break even from where you started. That will take you an entire decade. So the most important thing is to have a mechanism to avoid major loss. Everybody will lose a little bit of money in a bad market. The key is, how do you minimize it? Then how do you get ready for the next opportunity? So that's really an important principle. The other principle, of course, is to diversify very well. We've heard a lot of people talk about investing in Bitcoin and different, very speculative investments. And those who do that with a very small amount of their capital can survive if it doesn't work out. That's why people don't buy one stock, they buy 25 or 30 stocks. And they should do the same thing with bonds. They should do the same thing with alternatives and diversify, because mistakes will be made. No one's perfect. The idea is to minimize that damage And that's through diversification. That's your only savior, your only hope. Obi-Wan, that's my only hope.
Yeah, diversification and then protecting downside and really thinking about risk first. And as a fixed income investor, pretty much my entire career, we're always trained to think about the downside because the upside is relatively certain and known. Unlike stocks where you've got a lot more upside, but you also have a lot more downside. But I think in a market like this, thinking about risk first is the way to go ultimately, and staying diversified to your point. And what that means to me is not just diversifying across stocks and bonds, but diversifying into other asset classes like you're doing for your clients with alternatives. Are there any alternatives that you like in particular for this part of the cycle?
Well, sure. So there are a lot of corporate credit programs that are out there where instead of getting the small return that your bank will offer you, you can get a little bit more interest rate on the money that you have invested. And they're considered to be debt programs. And that's essentially what a bond is. It's government debt or a corporate bond. That's also a debt security. So rather than growing, you're getting interest for putting the money in. So it's a really interesting debt programs out there right now. Some you need to be careful of, and you need a good advisor to help you walk through that because we're having some credit issues with some of the banks. The offerings that you had been offering, Zach, the venture debt program is very interesting because venture capital is known as an area of growth and area of more risk perhaps than the stock market. But usually you've only been able to invest in venture as an equity investor. Now your group is trying to help folks invest in the debt side of venture. Venture capital companies do take on debt rather than just equity investors as well. And they usually pay some pretty nice coupons, and there's some good opportunity there. So that's one thing that we're looking at right now. And alternatives in general, I think are a pretty good investment here because the horizon is long-term. And I think over that cycle, even if we're having a bad year now, we'll have a good cycle over the next 5 to 7 years. So those are good investments to consider.
So segueing, but kind of building up what we were just talking about, are there resources that you've come across, like books, for instance, that you think every investor should read?
Sure. I'm gonna offer 2 ideas that would be really good if you really want to learn about the investing world and start to do some of it on your own, or just be more knowledgeable when you're working with your advisor. To learn about the markets in general, there's an old book written in the 1920s called Reminiscences of a Stock Operator. And it's about a trader who was working in the bear market rates of the 1920s. And it talks about how you can tell the market's strong and how the market's weak. Very often you will turn on TV like CNBC, Zach, and the market's up big, or down big. And, they tell all these stories as to why, but it really isn't clear. You don't really understand it. So when people throw up their hands and say, oh, I can't make any sense of this, this is crazy stuff. Well, it's really not. There's patterns that markets follow. So Reminiscence of the Stock Operator will help you understand how markets move, when markets are strong, how can you tell a weak market, and how you can protect yourself. And then when things are good, you can take advantage of a good, strong market. So that's one idea. The other one is just a general overall view, and it's written by a gentleman by the name of James O'Shaughnessy. It's called What Works on Wall Street. And it's a description of all the different styles of investing. If you invest in stocks for dividends or high earnings growth or book value or all the other possible metrics that you might invest in, what are the common themes that all those investing themes have? You may like a certain way of investing, but then it doesn't work at certain periods of time. So what are all the positive characteristics that are common to all of those themes? And that's what this book covers. And a lot of that relates to relative strength. If you're going to beat a benchmark, like the S&P 500, you can't index just like the market. You'll do no worse or no better than the market. So how do you diverge from that? How do you beat a benchmark? Well, you have to diverge from it. And the question is, how do you do that? And that book will help you figure out some of those ideas. And we can help you too. But if you want to read up on it, that would be a good book to understand.
Those are both great books. Earlier in my career, I was a bond trader, as you know, and there are very few books written on trading that are good. And I read that book, Reminiscences of a Stock Operator, And it really helped me a lot just in terms of understanding, risk sentiment and the psychology of markets as well. Another book I like a lot, another Chicago Booth grad, Howard Marks, wrote a book called The Most Important Thing, which I think is a great read in terms of learning about the various risks that investors face. And it's written in a way that you don't have to be a trained investor to understand it, and puts it in terms that are understandable. So that's another one of my favorites as well.
Mm-hmm. Great.
So I want to ask you, if with all the stuff that's going on in the banking market right now and all the dislocation, there's a lot of people moving money around, a lot of people taking money out of one bank and putting it into another. But I think a lot of people are also switching wealth advisors as well, mainly because last year performance was pretty bad in stocks and bonds, and the average client was in a 60-40 portfolio, was probably down about 20%. And then this year, things started off okay, but now we're heading into this uncertainty with interest rates and inflation and banking. And so we're seeing a lot of dislocation, a lot of movement. So if a client were to come to you, let's say they, we're a client at one of these institutions that is not doing so well, and they said, hey, we would really like some trusted financial advice. And they came to you with, a big chunk of money, and they didn't have any investment knowledge really. What would you say to them, and how would you think about planning?
Well, that situation happens actually fairly regularly, where we have people who come to us and say, I just sold a company, or I got an inheritance or something like that. So I think the most important thing is to either find a trusted advisor or learn up on yourself by yourself about how to invest. Although a large sum of money, you probably should get an advisor because they have experience. And the common theme is when people get a large chunk of money, they'll go buy a car, they'll celebrate, they do things. And that, that's fine, I guess, and in very, very small doses. But probably the most important thing to do right away is nothing, is leave that money right where it is and make a plan, work with an advisor to make a plan for what that money can do for you for the rest of your life, and not just this month or this summer. So, and if you don't have a plan, if you have a financial plan, then you can add those dollars into your financial plan. If you don't have a plan, it's important to sit down and figure out, what is this money going to do for you? And then what do we have to invest it in to get that return that we need to accomplish that? And so that's really a much, much broader discussion than, gee, what stock are we going to buy? Or do we buy this house or that house? It's a much broader discussion. So if you have an overall plan, then you'll not fall for the latest fad that'll come by and say, oh, let's put money here. Oh, let's put money there. Everybody will have an idea. Every friend you've ever had will probably have their hand out. So it's important that you have a plan and you know what will work in your plan. And then you can go forward and confidently invest if you have a plan.
Ryan, this has been super helpful. We're running out of time. What would you like to leave the audience with today in terms of parting thoughts?
Well, I would say this is a very stressful environment that investors are in right now. And I think the most important thing is that investors step back from this, never make very emotional decisions. Like I mentioned earlier, have a financial plan that will script out what your life looks like. You integrate Social Security, you integrate all the other aspects of your life into your plan, and then follow that plan. Bear markets like this don't go on forever. There's never been a thing, Zach, as a perpetual bear market. So if we know it's going to end, we have to prepare for the end. And that's where the opportunities are. So have an overall plan. And if you really don't know what you're doing, you're new to it, do work with a good advisor.
What's the best way for people to reach you?
Well, so we have a website, FourStarWealth.com, and you can reach us through there. You can sign on through the website, or you can just call our headquarters office in Chicago. It's 312-667-1750 is our main line. And you can ask for me. I'm Brian Kasal. I'm the founder and CEO of the firm. And if you want to talk about investing, we're happy to set you up with an advisor and get things rolling. And then also, if you want to learn more about FourStar, we have a podcast series called Today's Market Explained, and you've been a guest on that show, Zach. And it's available on Apple, iTunes, Stitcher, Spotify, and there's videos all over LinkedIn, Instagram, and Facebook as well, or little video clips of all the things that we're talking about. So if you want to learn a little bit more about FourStar and the things that we're saying, we're very well exposed out there. So if you haven't seen us, you've been living under a rock. So,
Brian, I love your podcast. You've done probably more than 160 episodes at this point, or maybe even more than that. So, prolific, and they're very helpful. They're very helpful. And yeah, I think I was on episode 153 talking about venture debt. So that's my favorite, of course. But they're all good. I learned a lot from them. So, definitely worth watching. So Brian, thanks so much for coming today. I learned a lot. I'm sure other people did as well. And everybody listening, we'll see you next time on 7 and 7.